This is the All-Star Charts podcast with JC Peretz. Hey guys, welcome back to the podcast. On today's episode, JC sits down with David Keller to talk about all things behavioral finance. David is one of JC's favorite guys to talk about the subject, and you can certainly tell that throughout their conversation. However, this one is not just an academic chat. David and JC also dive into current markets, discussing price trends, momentum, breadth, and even market sentiment. I think you're really going to enjoy this one. JC and Dave, take it away.
All right, everybody, and welcome back to the podcast. I am thrilled today to be joined by my friend David Keller. David, why don't you come on in?
Hey, good to see you, JC. Good to be with you, my friend.
Good to be with you as well. I pinged you recently. I was like, Dave, why don't you come on the podcast and let's talk about humans. Let's talk about brains. And then I was talking to the fellas earlier this week. I'm like, oh, I got Keller on the podcast this week. They're like, nice. So the guys are obviously fans of yours.
There we go.
And they've seen you actually give presentations and stuff like that on behavioral finance. I obviously have several times. Mm-hmm. So let's dive right in. Correct me if I'm wrong, but as technicians, right, which you and I obviously are, aren't we taking advantage and trying to profit from, the flaws in human behavior that go back, millions of years? Isn't that exactly what we're trying to do?
I would say that's the game. And it's funny, if you look at the early writings on technical analysis, some of it was really more just talking about the toolkit. But if you look at like Charles Dow's writings, he was really talking about behavioral finance. And a lot of different people have, Gann and many others sort of in the early mid 20th century sort of hit on it, even though they didn't describe it as behavioral finance. They didn't have this academic discipline to categorize all the reasons and methods with which we make poor decisions as humans. But they were developing a toolkit that allowed you to take advantage of that. And in terms of legitimizing what you and I and many others before us have used successfully to understand markets, to measure trends, to follow momentum, to do all of those things, are driven on investor behavior. And all that's happening with the rise in behavioral finance, the fact that we have ways to describe all these shortcomings we have that you really have to actively defend against, I think, in your investment process. All that's doing is just explaining why the charts work in a way that I think we've all seen for quite a while. It's giving a reason as to why they evolve the way they do, why markets move in trends, and why people are hardwired to make poor decisions. Unfortunately, I think there's a lot to be benefited from that for sure.
And then see if you agree with this. I guess I'm in the camp that I fall into, that fundamentals are what drives prices, but it's technical analysis that allows us to identify those trends to take advantage of them. Because whether you're a fundamental analyst or an economist or a technician, whatever it is, you can't argue against the fact that market prices trend. Stocks, commodities, they trend over time, right? Would you agree with all that?
Totally fair. And I always tell people that the reasons as to why the charts evolve the way they do always look crystal clear in the rearview mirror. Looking back, you can understand why rates went down, why gold went up when stocks went up. All of those reasons become really obvious after the fact when you look back and you can describe why a certain period played out how it did. But in the heat of the moment, looking at a 10Q or looking at economic data, while giving you certainly some information that's valuable over the long term, it doesn't help you at all, I would argue, in terms of where we're at right now versus where we should be headed based on the fundamental data. And technical analysis charts are the way to navigate point A to point B. It's not a straight line like the efficient markets hypothesis would tell you. Prices don't just automatically adjust to some magical valuation. They go in fits and starts because people get crazy and people get excited and nervous and desperate and panicked and euphoric. And the charts reflect all of those things. So, I've always said that, the price leads the fundamentals. The fundamentals would become clear down the road. The price is what tells you where the markets are headed at the moment. I think that's the most important thing to watch.
And then, you had a lot of experience at Fidelity. You got a couple more gray hairs than I do, respectfully, right?
That's fair. That's fair statement.
I hear a lot. I've gotten this throughout my career. JC, fundamentals tell you what to buy. Technicals tell you when to buy them. So you can use both. But for me, I look at momentum. I look at relative strength. I use a lot of intermarket analysis, which is all technical, to tell us what to buy, right?
Yeah.
And then
Yeah.
obviously when to buy and sell them, also based on price behavior. To me, and then I was like, JC, it doesn't have to be either or, it can be both. And then I think about it and I'm like, well, if the only way that we're gonna profit is to sell assets at higher prices than where we buy them, and not necessarily in that order, right? If that's the case, then why wouldn't our analysis both begin and finish with a study of price? And in my opinion, if you're going to take time away from that to look at those 10 Qs or whatever it is fundamental analysts look at, couldn't you use that time to go look at more price trends and analyze and do more technical analysis, right? Am I wrong?
Well, it's a fair point. And I would say, and again, at time of Fidelity, it was definitely the fusion approach was very much advocated. That was very much part of the culture, which was.
Is that a marketing thing or a
No.
strategy?
That was sort of like the culture inside the firm. It was sort of this marriage of good fundamental, backing, sort of the Peter Lynch methodology of finding good stories, good companies that have good earnings growth potential, but also that are good charts, right? And a good company doesn't necessarily mean a good stock. That's why looking at both of them together, right?
Vice
You want
versa.
good companies. That's exactly right. And what we would do is we would run a screen for stocks. We called it the trifecta screen, stocks that rated well by our fundamental team, our technical team, and our quantitative team that were basically modeling fundamental data on thousands and thousands of companies over time. And when all of those were positive, that was the best group of stocks. Those consistently performed better than the average stock in our universe. And so we learned to focus on the strengths of those. I think the argument for fundamental analysis, not to completely, dismiss it. I mean, if you look over time, earnings overall have done just fine. And in general, it's fair to say that price tends to follow earnings in that good companies that are able to grow earnings tend to turn into good stocks. That's absolutely right. I think what they're missing, which is what you're implying, which is absolutely right, is just because a company is earning it well, is earning, is having good earnings, doesn't mean that the price is going to go in your favor. And I would always ask people when they would, a new portfolio manager would sheepishly come into my office and say, all right, I'm getting killed. Can you help me figure out what I need to do? And it's all right, well, good company, good earnings doesn't necessarily mean it's the right time to buy. We need to look at which are actionable and what are the places where the charts actually tell you that this is a good time to be owning that story. And I think looking for that relationship, I think Craig Johnson, who we both know, does a great job of describing the PE ratio, right? A lot of analysts spend way too much of their time looking at the E part of that and not the price part of that. And I would argue if you're doing it right, you're looking at both of them. Just because the earnings are good doesn't mean necessarily that the price is at the right point. And so combining those meaningfully, I think, could be pretty successful. But if I had one, I would agree with you. I would go with price because I think the fundamentals become much clearer later.
All right, so let's talk about biases. So, one of the things, that I've noticed from the fundamental community is the amount of work that goes into and time that goes into deciding you're going to buy Apple or deciding you're going to short Microsoft or whatever it is that your fundamental thesis has. You've spent a lot of time. While a technician shouldn't take you more than 20, 30 seconds to figure out whether you want to buy it or not. And for us, since we don't really spend much time to make the decision, to change our mind or, God forbid, admit we got it wrong is really not that big of a deal because we haven't invested that much time and effort into that original decision. But getting back to the biases and the flaws that we have as humans, when you dedicate all that time, imagine if you flew to some place to check out the company and you had dinner with the CEO and it becomes like a lifestyle for you to admit that was wrong is much tougher, no?
It's absolutely right. And I would say in general, we were pretty nimble when you're rating a bunch of stocks using purely technical inputs. You're much more nimble in terms of your ability of recognizing when things are wrong. And, think of charts right now that are really rolling over, something like airlines, for example, right? There could be fundamental reasons why airlines could go up. I don't really know the fundamental story, but I know the chart of Delta Airlines is making a new 3-month low today. That's pretty much all I need to know that it's probably not a decent bet. And I think there are so many biases that we could talk about. One of them that is really painful is called the endowment effect or the endowment bias, which is basically you have an emotional attachment to a narrative, to a story, to something you own. And as a result, it clouds your judgment, especially when it should come time to cut your losses. So if you've done all this work and you've come up with this great thesis as to why Delta is the best stock ever, the price going down is not necessarily going to change that story. The story is probably something else. And so as a result, you're left, wedded to something that's really destroying your performance and really hurting you. So I think one of the best benefits we had for institutional money managers was saying, okay, here are the 100 stocks in your portfolio. Here are the 10 where the charts are really starting to look bad. We should really decide whether or not the fundamental thesis is worth owning it for a 10, 20, 30% loss, if that's what we might be faced with, because the charts are no longer attractive. And I think too often investors that don't use technical analysis are minimizing the benefit of managing the risk effectively using charts and looking for breakdowns.
Yeah, managing risk, definitely, right at the top of the list. But what about trend identification? How about that? We know, and even the fundamental community will agree that stock prices trend. So even just a trend identification part, I think is huge, right?
Yeah, so it's funny. There's a whole thing called the momentum factor, which wasn't a thing when I was getting started in the industry. I mean, I started in 2000, and I'd never heard anyone talk about the momentum factor. I'd heard about trends and I'd heard about trend following, but that whole thing came later. And I remember meeting with mathematicians at some hedge funds in New York and leaving this meeting thinking, what is a mathematician going to be doing at a firm? Which is hilarious now that, obviously most firms have a bunch of PhDs in math and physics that are just working on models. But you think about it, the whole momentum factor has been proven and validated so many times, which is the fact that stocks trend, and there's benefit in identifying what's working and leaning into those charts, and identifying what's not working and leaning away from those. And it's so simple, and it's something you and I take for granted because it's obviously how we were taught to follow trends and understand price momentum. But I always tell people the three things you should be trying to do as an investor, regardless of whether you're running billions of dollars as an institution or you're running $1,000 in your Robinhood account, is to identify trends, follow those trends, and anticipate when those trends are exhausted. Like, that's it. And all the other stuff is just stuff. It's noise that gets in the way, I would argue, of your ability to do those three things. And I think your main goal should be focusing on what's working and focusing on what's not working, casting a wide net, screening for ideas, looking at a lot of charts, as you and I both do, I know, as part of our weekly process, our daily process. And it's all about identifying those trends and leaning into them. It's tended to work pretty well over the long term.
All right, so looking at the 3-month low list, not a good place to look for buys. So I'm going to write that down.
That is a great, pro tip, JC.
Pro tip, got it. Don't forget that. 3-month lows, not on the buy list. Okay. So what about, so all of this is really sort of a derivative to the loss aversion bias, right?
Yeah. Yep.
The inability for us as humans to put our ego aside. The fact that, throughout evolution, us as humans, we want to be part of a crowd. We want to be part of a community. That's how we're able to survive. So it's perfectly natural. So we want to, we want others to recognize how smart we are or how great we are. So for us to take a loss and show everybody that we were wrong is the opposite of how our brains are designed to work, right?
Yeah,
but we got to get over that.
You totally do. And you mentioned the focus on risk versus return. When I've worked with any analyst or any money manager who has a background in fixed income, who was like a bond analyst or something, they focus so much on risk, and it's beautiful. I think it serves you so well as an equity investor, because a bond investor, a bond analyst, focuses mainly on how much they stand to lose if the bond doesn't play out as expected. Stock investors, growth investors, think much more about potential reward and a lot less about the risk. So I found people like Steve Suttmeyer, who's at BofA Securities, right, the technical analyst. He started as a fixed income analyst, and I think as a result, he's programmed more to think about what could go wrong, in what scenarios it's not going to work. And I think a lot of individual investors, unfortunately, spend way more time thinking about potential reward, not enough time thinking about potential risk. And as you and I are taught, right, when you're reading John Murphy or Martin Pring or Edwards and McGee, it's all about defining your risk and your reward. What do you stand to gain? What do you stand to lose? And make sure you're comfortable with that relationship. If all we're doing is thinking about potential upside, we're thinking of this thing going up tenfold, whatever it is, a coin, an ETF, a stock, whatever, and we're not thinking enough about what we stand to lose if the thing goes against us. If all we're doing is trying to find validation from others and find a cohort that is equally as euphoric about it, this is how bubbles form and how they come crashing down very quickly, because that's not a sustainable move. So for any new investors, when they ask me how to approach it, I always tell them, think as much about risk, if not more, than you think about reward, and you're gonna withstand a lot of painful investing experiences.
And then, Dave, this really comes down to go get your dopamine fix somewhere else, right? Right? Maybe go to a football game, maybe go on a run, go play with your kids. Get your dopamine fix anywhere but the stock market, because like you said, people are thinking about how much money they're going to make. That dopamine is being hit when they're thinking about that, right? The dopamine hit comes when they're buying the lotto ticket and thinking about how much money they're gonna make. The cocaine addict gets his dopamine hit when he or she sees the cocaine, not when they're actually doing the line, right? So it's all about that thinking. That's what you're paying for, is the 5 minutes of what am I gonna do if I win the lotto? Or what am I going to do when the stock goes up 10 times, 15 times? The actual process of doing that is not where you're getting your dopamine. So, to move over from the descriptive process into the more prescriptive side of things, if you're getting your dopamine hits elsewhere, that's got to help in the market, right?
I think that's totally fair. And if you look at what's happening, sort of the Robinhood effect, right? So this new group of investors that are using Robinhood or Webull or one of these, a mobile app to trade. There's the confetti, the unicorn flying, whatever it is when you make a trade. I mean, it's gamification, it's gamification of it, but it's really encouraging you that it's giving you that rush. It's just like when your email dings and you feel all good that someone wants to ask you a question or something. It's not really great. And I would argue you should probably turn those kind of things off. And the better thing to do is turn off the confetti cannon when you're trading. Turn on the confetti cannon when you haven't done anything in a week and you've left things alone and you've let your profits run. That should be like the nice job, you didn't mess it up. I'm concerned about the behavior that we're encouraging. Any financial media, when you bring up your brokerage account, it doesn't show you a long-term chart of how things have performed over time. It probably shows today's flickering ticks, and it shows the short-term action in the markets because they want to draw you in and get you to do something. Yeah. And I think for a lot of, especially new traders, trading as a verb doesn't have to mean actually taking action and making a trade. If you're doing it right, it should be really boring a lot of the times. And I think a lot of people are trying to do it for other reasons besides wealth creation, which is really the goal, or wealth preservation.
If you are in the market for any other reason other than to make a profit, you are very, very confused. Like, you got the people that are trying to save the world through their portfolios, and only buy certain companies that fit certain parameters. Like, oh my God, I can't think of a worse idea. But so, and again, I don't want to pick on Robinhood because they all do it. All the brokers just do it. When you enter a trade, I mean, it might not be confetti and unicorns, but you're getting a very pleasant sound, like a bling, just a very nice, soothing sound. What it should be something more like, you probably shouldn't have done that, right?
Give you 4, are you absolutely sure you want to take this action?
How
right?
sure are you?
I mean, and it's funny, I think, for me, it was formative for me. I spent a lot of time at Bloomberg in my earlier part of my career, at hedge funds, at trading desk, where there was a lot of turnover, a lot of activity. And then I rotated to a traditional buy side institution, and I was struck by two things. Number one, how boring the process was. A lot of portfolio managers didn't do anything to their portfolios most days. A lot of it was just thinking much bigger picture, thinking, more longer term, and focusing on how trends were evolving. Trends didn't just happen. It wasn't just a moment. It was a process. And sometimes it was a sluggish, Titanic-like process, but that was the game they were trying to do. And they knew that the game that they were trying to operate on, but it was a lot of inactivity. If you're doing it right, it was not super active. And the second thing was a lot of focus on turnover. We thought about turnover, and any sort of quantitative model was meant to balance upside potential, like alpha, of what you stood to gain from the model, versus the turnover. If it was turning over your portfolio a couple times a year, it just was not practical to apply it. And so you'd have to scrap it. So it was this balance between how can I stand to gain from this particular approach, and how can I limit my turnover so I'm not just churning my holdings for no good reason. I'm not really gaining the benefit from it. And I think, again, a lot of individual investors don't think of the impact that turnover, which is basically just how much you're rotating positions, how much that's really impacting not just the cost, but just the fact that you're not really able to benefit from trends if you're changing it all the time.
It's a great point. Let me ask you this, Dave. When it comes to support and resistance and polarity, and for those of you new to technical analysis, this is the stuff they teach you on the second day of technical kindergarten, right? Former support turns into resistance and vice versa.
Yeah.
Isn't that just a visual representation of anchoring bias, right? I'm just
Yeah.
trying to get back to break even. Oh, it worked
Yeah.
last time. I'm going to buy more because it's back. Like, isn't that just what that is?
I think that's absolutely right. I think you're doing well by sort of recognizing the technical. There's a reason why support and resistance works. Right, that's been validated by so many strategists and analysts and money managers forever. Right, is that idea that the market has memory and that key price levels come back to play. And what you're referring to is anchoring, which is basically the meaning that a particular price level means here. I would say anchoring, priming when you're primed to a certain price level, also sort of impacts your ability to interpret what's going to happen next. And we've seen that in plenty of places. You've seen that when stocks like a PayPal hit resistance and then comes right back up to it. And then that's where it happens to fail. That's not a coincidence. And I think part of it is the anchoring. Part of it is the fact that, investors may have been underwater. I think that's a lot of times when there's a consistent support level and then it finally breaks, why there's a flood to the exits, because everyone that bought at those lows and feels like a rock star genius betting on this mean reversion, everyone's underwater like that. And that causes a panic sell that causes things to really accelerate to the downside. But you're also seeing it on a chart like Apple, where, we're here the first week in August, Apple sort of hit resistance a couple months ago, broke above it, and now it's just kind of sitting right down on that breakout level. And I think that tells you all you're going to need to know about the market in many ways is that chart of Apple. Does that resolve to the upside to get follow through and push higher, or does that support fail? And that's that polarity concept where resistance has become support. Does that hold or not? I think charts like that tell you a great deal about the emotional state of investors and what they're looking for.
I love these conversations, Dave. It's why I pinged you. I was like, let's talk about humans and our brains and why we're so crazy. Because correct me if I'm wrong. Listen, we can sit here talking about it all day, but it's not necessarily going to take away those emotions. Our brains aren't going to change just because you and I are talking about it. But I would argue strongly that just being aware of those biases and the fact that others do too, just the awareness alone already gives us a huge leg up over 99.9% of investors who, don't understand the way that our biases work and the way our brains work, and number two, don't even care to learn. Just the awareness alone, like, when you have your own biases, like, okay, so I didn't buy this stock, and then a week later it just rips, right? I'm going to feel that FOMO. I'm going to be like, oh, JC, you idiot. I knew that it was going to go up. You should have bought it, right? But instead of being so angry at yourself about it, if you can just chuckle, be like, haha, there's my FOMO kicking in, right? And just kind of chuckle about it, be like, I guess I'm still human. And then you don't act upon that as opposed to revenge trading and chasing it up. Being aware of those, I catch it myself. And isn't it better to chuckle about it and just understand that you're still human versus letting it dictate your next actions?
You hit on so many good points right there, JC. And I think two things I would point out. Number one, I was interviewed earlier this week on a podcast devoted to Bitcoin and cryptocurrencies. We talked about Bitcoin and Ethereum, but we spent most of our time talking about human nature. And what I explained, they're asking about the new asset class, how to think of it. Is it a currency? How to approach it?
Right.
Are the technical patterns similar to what you've seen in other asset classes? And I sort of explained to them, while it's a new asset class, I think in a lot of ways, the dynamics of it are certainly unique because it's a new thing, the human component to it is so not unique. And Bitcoin has already gone through boom bust cycles like any other asset class, like you and I have studied many, many times. There's a universal nature to how humans operate, and there's nothing different. There's nothing new about that. It's just the tickers that we're looking at that are going to be a little different, but I think the consistency is there. And I think you're right. How do you minimize that, or how do you actively work against that? I found from working with really successful investors, the ones that I've been able to work with have really good self-awareness. They can tell you very quickly what they're good at, and they also have a great awareness of what they're not good at. And what I found with novice investors, they tend to feel like they're really good at a lot of things that they may not necessarily be good at. That's where you get things like overconfidence and bravado and revenge trading and feeling like, the illusion of control, feeling like you can force this thing to do what you want. And the great investors have a great self-awareness. They know what they're good at, and they set themselves up to benefit from their strengths, but also minimize the impact of their weaknesses. And at an institution, what we would do is surround a portfolio manager with groups of people that helped address their weaknesses. If they didn't have a great quantitative sense of the structure of their industry. We had a quantitative analyst assigned to them that their whole job was just to run a model and help them see, here's what's happening in your space and here's what you don't understand because it's not part of your thinking. And I think for individual investors, you have the same benefit. While you may not be able to surround yourself with the team necessarily, there are resources you should be surrounding yourself with. Think about what is in your control, your routines, how you make decisions, what information you consume, and when during the trading day. Those are all things that you can improve on, I bet, from what they were yesterday. And that's what I would hope that your listeners focus on.
Yeah, and that's really on preparing your own mind to be in a position to excel. Don't go out drinking, doing drugs all night, and then expect to be, make good decisions the next morning, right? Yeah. Go for a walk, do some yoga. Like, these are just all things, eating healthy. You're eating candy till 2:00 in the morning. Like, chances are you're not going to be feeling too good in the next morning. Like, but these might sound like common sense, but they're little things that I think can go a long way. You mentioned something, David. I've got a question for you. And this is a tough one. I think this is tough for me anyway. So you talked about overconfidence, right? And when you're overconfident, the risks are your position sizing could get larger. The risk management could be lacking, right? There's a lot of dark alleys you can go to with too much overconfidence, right?
Yeah.
Fine.
Yeah, absolutely.
But on the other side of the coin, when you're hot and you're feeling that market, you want to be pressing, especially if you got P&L on the table that you could really press. How do you find, where is the line between overconfidence and irresponsibility versus you're hot, take advantage? We're playing Ohio State, their defensive line sucks, just keep running the ball down their throat, for example.
It's hard for me to understand that hypothetical scenario, JC. So I'll move past it very quickly because I couldn't see that happening. I think you're right. What's the difference between confidence and overconfidence is what you're basically saying, right? Confidence seems like a good thing. And I know I was taught, at a big buy side firm, you need to, pound the table when you're confident and you have the right thesis and you want to make sure that you get the shareholders there. But how do you fight overconfidence? I think it comes down to discipline. I think that's the key word. And, when I'm working with people, I spend a lot of time coaching investors and financial advisors. We talk a lot about their discipline process. How are you actually making decisions? And I start them with a checklist. Write down the thing. You show me exactly how you're making a decision. Tell me what steps you're going to follow. And if you're confident, all that tells you is to keep following your checklist and keep doing things. It doesn't tell you to do something completely off script. And I think that's what overconfidence does. It gets you away from what got you there and all of a sudden gets you into other things. It causes you to take actions you would not normally take if you're following your process. As you and I have talked about, I know I've spent time trying to fly airplanes and learning how to do that. And, I was struck from the very beginning how it's all about having checklists for everything. You don't do anything. You don't touch the plane. You don't get in the plane. You don't turn anything without having a checklist that you follow. And that's what millions of pilots have done consistently. That's what minimizes the chance of something horrible going wrong. You don't go off the checklist. You don't just decide, I think I got it. I don't think I need to follow these steps to land the plane. You hit every step as you always do, because that's how you know the plane's going to land. That you could do it without following the checklist, but your chances are much lower. And I'd much rather have a higher percentage chance of walking away from the airplane after I hopefully get it on the ground safely. And so I think as investors, it's all about discipline, being confident and, seeing that things are going well, letting profits run is all really, really good, but don't get away from your game plan. You should have something. And for new investors, I tell you, literally write it down on a piece of paper and answer the questions. Then you've earned the right to make the trade at the bottom of that piece of paper, not at the top when you just decide, hey, I think this stock's going to work. There's a lot of very, amateurish applications of technical analysis. I think one of the great things about social media is it's such a great level playing field for so many people to exchange ideas. You particularly have done a great job of, I think, of showing people that and encouraging people to exchange ideas. I think that's awesome. But there's also sort of the underside of that, which is there is very little barrier to entry. There's no one checking to make sure that what you're doing is actually a really good idea. And as a result, I think, following a disciplined process with any decision, but particularly with technical analysis, is going to help you avoid overconfidence as much as you can.
I like that checklist. One of the things you said about the flying the planes is that you'd rather be on the ground wishing you were in the air than in the air wishing you were on the ground.
It's a Greg Morris quote. It was a fantastic technical analyst and a military. He was a Top Gun pilot and flew for Delta for a couple decades. And he always described that, it's much better to be on the ground wishing you're in the air than in the air wishing you're on the ground. And I've been in that scenario where you're in the plane and something goes wrong. And there's this moment where it's like, I so wish this was Flight Simulator and I could just turn the computer off, but you can't. If you have a bad day, things go really bad and really poorly. And luckily I had an instructor next to me, which took control of things and made things right again. But there are moments that you have to kind of work through. And again, being caught in a position that is not ideal happens a lot if you're not following a disciplined process. And I think that's one of the most important things.
All right. All this academic stuff is fine. All right. We got it out of the way. Now let's get down to the nitty gritty of things. Yeah. In my estimation, based on my work, the market peaked in February. The stock market peaked in February. That was the best it was. Then we had further strength out of a smaller portion of those names into May. And that's when the rest of them, if you will, peaked. And then since then, and for the most part of the year, since the second week of February, it's been an environment where some stocks are working, most stocks are not, right? Yeah. So it puts us in a little situation where, okay, I remember seeing something similar in 2015 when most things peaked in the fourth quarter of 2014, and then into May of 2015, S&Ps and the Dow put in their highs, and then everything fell apart that summer.
Yeah.
How are you viewing it where it could be another 2015 and we do fall apart in August and here we are coming into August? Or is it a situation where the rotation comes in, the names that are underperforming now take over, things like small caps, right? Mid caps, micro caps, the average stock in the NASDAQ is down 26%. 26% average drawdown in the NASDAQ. And I realize there's a lot of junky stuff in the NASDAQ, but even if you look at the NASDAQ 100, which I believe is the best performing index on earth, the average drawdown is still 10%, right? Yeah. So how do you view breadth and how this ultimately resolves into the end of the year?
Yeah, so I've been describing this market as a stealth correction. I always tell people the market can correct in one of three ways. The first is a price correction, which we saw, and again, maybe in the recent history, sort of February to March 2020, a price correction. It took a very short amount of time. 2009 was a similar one, sort of accelerated to the downside, but a V bottom, it was over pretty quick, but it was still down 30+%. You have sort of a time correction, which is what we saw last fall, sort of September, October. We basically didn't go down a whole lot. We just stopped going up. And it was really maybe a big consolidation. But the third one is really sneaky and annoying. And I think that's what we're in now. And I think that's called a stealth correction, right? Which is basically the market, depending on how you define it, is either just fine or it's a hot mess, right? And your portfolio, it's the worst feeling when the market is going higher and your portfolio looks horrible and things are just really struggling. I think for a lot of investors, that's what they've seen, because depending on what you've been owning, if you bought into that cyclical trade as they really started to emerge, financials sort of April into May, you've gotten killed since then.
Right. May they all peaked, industrials, materials, they all peaked in May.
Yeah, it's tough. And if you look at the momentum factor ETF, the MTUM, it rebalanced right there in May, basically as financials were just breaking down. And it's been brutal, right? So I think you're absolutely right. I think the correction has been in place, even though the price is not necessarily reflected. And the question is, what would need to happen for us to have a little more of a correction we might be used to, which is more of a price correction? I think you're absolutely right. Is there a chance that cyclicals just completely reemerge and break to new highs? Absolutely, anything is possible. I think what's much more likely is stocks like Apple and Amazon and Facebook and others that almost single-handedly have kept the indexes looking a particular way. They start to feel the weight of being dragged down by all the other stocks you mentioned that are already going lower. I think that causes some short-term pain. You mentioned we're in sort of July, August, September. That's seasonally the weaker part of the year. That's when a lot of things tend to be relatively weak if you look at the batting average on the S&P. So I think that's a pretty fair time for that to happen. I can't ignore the breadth deterioration that's been pretty widespread. Small caps underperforming, the advanced decline lines for the most part rolling over pretty significantly. Only the 55, maybe 60% at this point of the S&P above their 50-day moving average. That's a lot of stocks that were above their 50-day moving average back in April and are no longer above their 50-day. That's not what a sustained bull market looks like or feels like. So the question is just, What could happen? Anything could happen. I think I'm more in the camp of, you think defensively, you're thinking more about potential risk than potential reward at this point. My model suggests limited upside and the potential for downside. And that tells me to be focusing less on what's going to go up tomorrow, even though there are plenty of charts still going higher within healthcare, within tech, medical supplies. Like there are charts that are just, S&P Global, like there are plenty of things still going up and to the right. I don't think those charts are broken yet, but I think on average, it's better to think more about defense and think more about sectors like real estate that are defensive and are performing very well. That's the kind of place that I would rather ride this out in.
100%. So I guess we're in agreement there. What about this resilient strength out of base metals? Steel, tin, copper hovering near highs. If you would have told me, if I would have told you, chances are you probably agree with me, if, Latin American stocks getting crushed, the dollar hanging in there pretty good, lumber down 70%. What would you have told me base metals are doing?
Yeah, not this. And it's interesting how it sort of played out like this, right? Commodities overall, I think it's a really good story. I think it's a long-term decent story. You've seen a lot of the commodity complex start to roll over a little bit. And I think there's some give back to be had there. Crude oil is maybe the best indication of how those have rolled over a little bit with the lower high that it's put in here just recently. And I'm concerned a little bit about what that means for energy. If you think about the cyclical recovery, I would be looking for crude oil to be doing something different than it's doing right now. But I think the strength in base metals is a great illustration of what you and I talked about earlier, which is the value of trends. If I had told you before the start of 2021, the market's going to make new all-time highs every month, which sector do you think is going to be the best performer or in the top group? I bet real estate would not be one of those sectors you would most likely name. But it's been up. And if you look back in that 2014 period, the top two sectors in the S&P were utilities and real estate in the calendar year 2014. So, even if you have perfect foresight, you know what's going to happen, you don't necessarily know what stocks or ETFs or sectors to allocate to. I would focus on the trends. And again, the reason why those charts look the way they do will make a lot of sense down the road when someone writes a book about 2021. For now, follow the trends and lean into what's working.
All right, I got another tough one for you, Dave. Sentiment. I'm looking, one thing that we do is that we'll take the number of bears. Everybody's like, oh, JC, what's the best sentiment poll? The answer is they all have their flaws. In my opinion, it's about aggregating all of them. One thing that we do is we look through financial advisors, particularly when they're consensus as contrarians. Same thing with individual investors. We'll group both of those together. And we'll take the average amount of bears between both polls, the II advisor poll and the AAII individual investor poll. And we don't have any bears. There aren't any bears. The fewest amount of bears since early 2018. Do we need a reset in sentiment for stocks to go up? Is that a need or a want?
So it's a really good question. I tend to advocate sort of a 3-step process to macro analysis, and it's in priority order: price, breadth, then sentiment. Price is most important. If you know nothing else, as Ralph Eckenport taught me early in my career, look at it. If you want to know what the S&P 500 is going to do, if you want the best thing to do, look at a chart of the S&P 500. Just the price. Everything else is other stuff to supplement that. And I think there's a lot of validity.
Papa Dow.
That's right.
Don't fight Papa Dow, JC.
So price has to be first. Breadth is second for me because that tells you about participation. I think in this environment in particular, it's helping you understand this corrective environment that isn't reflected necessarily on the S&P or the NASDAQ charts, but it is if you look at transports and small caps and other things, right? The third part of that is sentiment, which are just, for me, ways to qualify what you're seeing in those other places. And I think contrary opinion makes a ton of sense. If you read Humphrey Neal's book on contrary opinion, it's beautiful and it's super antiquated. It talks about keeping a paper scrapbook and clipping the newspaper headlines. But the idea was really good. And we looked at magazine covers. You've tweeted out magazine covers recently talking about, EM being highlighted. And I think in general, that's interesting. But what it does for me is it causes me to look back at price and breadth and dig deeper. So, to your question in particular about survey data, you're absolutely right. I mean, any of those surveys have flaws to them by definition. There's no way, because you're sampling a subset of the investing community, and the whole methodology of it, the timing of it. There's a lot of room for error. Having said that, there's no doubt that there have been extremes of sentiment at major turning points that you can look back and recognize. So There is a noted absence of bearish sentiment right now. I think that's absolutely right. I would say on the other side of that, you're not really seeing euphoric bullishness. You saw that earlier in this year, really back, a couple months ago, maybe February, maybe into April, March. You saw some euphoric sentiment, but it's really not there anymore. You really don't have people ridiculously bullish anymore. It's more kind of mid-range for a bull market phase. So for me, again, I think it's interesting, but I would always go back to price and breadth as the main indicators.
Yeah, I mean, realistically, where do seasonality and sentiment fall on the scale of highest weightings? Do they even break the top 10? I'd argue probably not.
Probably not. And seasonality is another good one, right? Is it, when I love people talk about sell in May and go away
or something?
It did. And, in May, I'm sure you, as I do, get a lot of questions about sell in May and what are you doing? And my answer is always follow the trend. Like, it doesn't matter. The market doesn't care that it's May right now. The market's doing what it's doing, and I would follow the trends. And so I think seasonality cycles are all very interesting. I find that interesting to see when it lines up with what I'm doing elsewhere. But as a trend follower, as a momentum investor, you follow the trends, and the other things are just other ways to validate that.
All right, Keller, what are we buying? Here we are, early August. You get one trade for the end of the year. You're selling it on New Year's Eve if the market's even open that day. I don't know what day of the week it falls, but let's just say it is. One trade. What are you buying or shorting?
Boy, this is a really good question. There's so many ways to answer that. So I'll do something completely abnormal for me. I don't do pairs trades at all, really, but I would say the long Regeneron short Delta Airlines pairs trade is a beautiful way of thinking about the emerging strength of healthcare. If you look at those two charts, they are inverted. Regeneron with this beautiful rotation back to the upside, Delta Airlines with this rotation lower. And I think it recognizes when I'm screening in recent weeks, I'm finding a lot in healthcare and a lot of tech. So it's got to be one of those. And then on the downside, I think the cyclicals keep struggling. I think that might be a decent way to express that. Not a recommendation, but that's a trade I would consider.
Long Regeneron, short Delta specifically of all the
airlines. You may have not had that before on the show.
That's the one you hate the most, Delta?
Just kind of came to mind. I mean, those are good example stocks of, I think, the theme. Maybe it's long healthcare, short industrials is sort of the idea. But I think, long in an area of emerging strength, which is healthcare, shorting something that's really struggling that I think continues to show weakness, which is industrials. I think that's a fair play.
And then when it comes to crypto, do you just throw away all of that self-awareness and just diamond hands, YOLO all day? Is that how that works?
I hope not. I think that's how a lot of people are setting themselves up for that, right?
How do you feel about the whole thing?
I don't. I mean, I think, I think there's what you have to recognize with something like cryptocurrencies are that you are buying into, if you are trading them, you are buying into a high volatility, high speculation environment. And it's all about risk versus reward, right? If you're bothered by a 50% drawdown, a 70% drawdown, I would not be looking at Bitcoin on any time frame, because that is a very real and very actual part of that. Even given a long-term upturn, you've had periods of ridiculously bad drawdown, but most momentum models tend to have a pretty steep drawdown anyways, right? By definition, you're going to be in there for some really good trends, and you're going to feel some pain when things get really choppy. So is there upside for cryptocurrency? Absolutely. Or is there upside for Ethereum? Definitely. I would argue, is there upside for Bitcoin? Absolutely. I don't see the reason why it would need to go to not do that. But I would say that you have to understand that it's not a direct point from right here to some, ridiculous high multiple of where we're at. There are some really painful movements. I think we're in the middle of one of those right now as we chop around sort of that 30 to 42K range.
Are you yield farming at all? How far down the DeFi rabbit hole have you gone? Are you yield farming?
I am not. I tend to keep my approach is super plain vanilla. And I think that comes for me, that methodology, that mentality probably comes from Fidelity days and Peter Lynch, which was, there are a lot of ways to get cute with a lot of strategies. Keep it straightforward. Keep it super straightforward. So for me, I mean,
yield
with my own,
is like writing covered calls or like owning dividend stocks and reinvesting dividends. Isn't yield farming the same thing?
It absolutely kind of is, but not really. It's not my game, JC. I would say, is there a reason to be looking for income away from bonds right now? Absolutely. Are there ways to do that at relatively low cost? Absolutely. But for me, I'd rather buy buy REITs and be super boring about
it. I had to ask. The kids want to know, Dave. The kids want to know. All right, ready? So, what's going to be the Ohio State University football team record this year? How many wins?
Come on.
How many wins?
Before the season, we're all going to be undefeated. Come on. An elite
Miami,
program
Ohio State national title game? Is that what you're calling?
An elite program like the Ohio State University, JC, as you know, they don't, they reload, right? That's where we're at. So we'll have another strong year as expected.
If Miami, Ohio State go to the national championship game, we're going. Deal?
That's a total deal.
Deal. Done. All right, Dave. Thanks for stopping by, man.
You got it, JC. Thank you.
And that's today's podcast. Thanks for listening. You can catch up on recent episodes at allstarcharts.com/podcast or search All Star Charts on your favorite podcast player. See you next time.